Welcome back to Investing Talk Podcast.
Today we're looking at Arista Networks.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, so Arista Networks. They're positioned, right at the center of some of the biggest trends out there.
Yeah.
Cloud, AI data centers, high-speed networking.
Exactly. They are basically the plumbing for the AI revolution. And that position is really starting to show up in the numbers. It's pretty incredible.
Incredible how? Let's talk specifics.
Well, if you look at their most recent quarter, Q3 2025, revenue hit, $2.308 billion.
Which is a huge number.
It is. And it's up 27.5% year over year.
Yeah.
For a company this size, that's just explosive growth.
And that's not just broad market growth, right? It's very specific.
Very specific. It's all being driven by the shift to 400G and 800G networking.
The really high-speed stuff.
The really high-speed stuff that you absolutely need for cloud and AI data centers. That's where all the momentum is.
Okay, so fast growth, that's one thing. But what really stands out with Arista, and what I find fascinating, is the profitability. Hardware is usually a tough game. Margins are thin.
It's a razor-thin margin business usually. But Arista it's a whole different ballgame. We're talking about a net margin of around 39.7%.
Almost 40%.
Almost 40%. And a return on equity of over 30%. You just don't see that.
No. So you have this combination of nearly 27% growth and software-like margins. How are they pulling that off?
It's their secret sauce. It's primarily their software platform, EOS, and just incredible operating leverage.
Unpack that for us. Operating leverage.
Right. So simply put, as their revenue shoots up, their costs don't grow nearly as fast.
I see.
A lot of their product mix is in these fixed configuration switches, which are efficient to build. But the real value, the thing customers pay a premium for, is the software.
EOS, the extensible operating system.
Exactly. You spend a lot up front to develop it, but then every new switch you sell with it costs you almost nothing extra on the software side. So profit just scales beautifully.
That must give them a ton of confidence looking forward.
Oh, absolutely. The guidance is very strong. For Q4 2025, they're guiding for up to $2.4 billion.
And longer term, what does the AI story mean for them over, say, the next few years?
That's the real story here. The outlook for 2026 is around $10.65 billion. And that's explicitly tied to sustained AI demand.
Wow.
And if you look out even further, some models project they could hit something like $13.6 billion in revenue by 2028.
So that's roughly a 19.5% annual growth rate?
For the next 3 years. It shows this isn't just a one-off good quarter, it's a structural trend they are riding.
Okay, but with growth like that and margins like that, you expect fierce competition. What's the moat here? You mentioned the software, EOS. Why is that so hard to compete with?
This is the core of it. EO is not just some operating system on a switch. It's a single programmable platform across their entire portfolio.
And for a cloud engineer, what does that practically mean?
It means automation. It means telemetry. It means you can see everything happening on your network in real time at a massive scale.
Telemetry, so visibility.
Deep visibility. In an AI cluster, you can't afford latency. A tiny delay can mess up a whole training model. EOS gives them the tools to see problems before they happen and automate the fixes.
So the intelligence is in the software, not just the speed of the box.
Precisely. And that creates enormous switching costs.
Right.
Think about it. If you're a massive cloud provider, you've built all your tools, all your scripts, your entire operational playbook around EOS.
To change that.
To rip that out and replace it with something from a competitor, it's a multi-year, multi-billion-dollar headache. You just don't do it.
So you're locked in. It's not just a vendor relationship. They become part of the architecture.
They're completely entrenched. And that's why they have such a sticky, reliable customer base among the biggest players.
Let's talk about the foundation underneath all this. The balance sheet. I've seen it described as flawless.
That's a fair description. They have a huge net cash position and basically zero long-term debt.
Which gives them a lot of flexibility.
Immense flexibility. They aren't beholden to lenders. They can pour all their energy and resources into R&D and growth.
And the cash flow must be pretty strong, too.
It's incredibly robust.
Yeah.
And they're plowing that cash right back into the business, improving the software, developing new AI platforms, and they're doing share buybacks.
Right. Returning value to shareholders without a dividend.
It signals a lot of confidence from management that the best investment is in their own stock and their own growth.
Okay. The fundamentals are clearly top tier. But let's look at the stock itself. It's been on a bit of a ride.
It has. It's traded in a pretty wide range, from about $117 to $162.
And right now it's sitting around $129, so it's pulled back a bit.
Yeah, it's down about 16% from the recent highs.
A 16% drop can make people nervous. Is this a sign of trouble or something else?
I think the consensus here is that it's more of a healthy consolidation, a valuation reset.
Reset.
Yeah, the stock had a monster run on the AI hype. This is the market just taking a breather, letting the fundamentals catch up. It's not seen as a breakdown.
And are there any technical levels that support that idea?
There are. The key level everyone is watching is the 200-day moving average.
The long-term trend line.
Exactly. It's rising, which is a bullish sign, and it sits at around $124.92. The stock is currently trading just above that.
So institutions see that as an area to buy in.
It's often viewed as an attractive accumulation zone for long-term buyers. You're getting a chance to buy into a long-term uptrend without chasing the price.
And speaking of institutions, their ownership is pretty high, isn't it?
It is. It's over 82%. That's a huge vote of confidence. And you're seeing big firms adding to their positions even on this pullback.
But we have to address the elephant in the room. Insider selling, the numbers look pretty big.
They do. Around 2 million shares sold by insiders in the last quarter. That's a headline that can definitely spook people.
So how should you interpret that?
Well, you have to add some nuance. A lot of these sales are often pre-scheduled automated plans. It's not necessarily an executive saying, I'm getting out now.
Still, shares are being sold, but institutions seem to be buying them up.
They are, because they're focused on the multi-year picture. They believe the long-term earnings growth from the AI build-out will far outweigh any short-term selling pressure from insiders. And fair value estimates are still way up around $164.
Okay, let's play devil's advocate. We've laid out a very strong bull case. What could go wrong? What's the biggest risk here?
Without a doubt, it's customer concentration.
Too many eggs in one basket.
Exactly. A huge chunk of their revenue comes from just a handful of hyperscale cloud companies. Their spending can be very lumpy.
So if one of them taps the brakes on spending for a quarter,
It would have a material impact on Arista's growth. And with the stock's high valuation, any disappointment is punished severely.
and let's talk about that valuation. A PE ratio around 49. That's pricing in a lot of good news, isn't it?
It is. It leaves very, very little room for error. A growth miss, or even a slight dip in margins, and that multiple could compress fast.
So what's the counter-argument? Why is that PE maybe justified?
The argument is that you're paying a premium for elite quality. Even if margins dip a little, they're still near 40%, which is fantastic.
And the AI trend isn't going away.
It's just getting started. Plus, Arista is actively working to diversify, moving more into the enterprise campus market to smooth out some of that hyperscaler lumpiness.
So looking ahead, say, the next 3 months, what are the key catalysts we should be watching for?
The big one is the Q4 earnings release, which should be in early February.
And what do you need to see there?
You need to see them not just hit their Q4 numbers, but more importantly, you need management to confidently reiterate that big 2026 outlook. They have to stand by that $10.65 billion number.
And they have some investor conferences before that, right?
They do. A few TMT and tech summits, those will be key opportunities for them to manage expectations and reinforce the strength of the AI demand they're seeing.
At the end of the day, it's all tied to those big macro tailwinds.
Completely. As long as the big cloud players are spending billions on AI infrastructure, Arista is in a prime position. The whole industry is moving to 400G and 800G networking, and Arista is leading that charge. So if you put it all together, what you have is this really rare combination of high growth and best-in-class margins. It's built on a rock-solid balance sheet and defended by a really sticky software moat. In a lot of ways, Arista is a technology toll collector on the AI highway. The recent pullback could be seen as a tactical entry point for a long-term compounder.
It's a compelling story. I think the question for you to think about is this. How much of that premium valuation is justified by their genuine sticky software advantage versus how much is just tied to the temporary AI hype cycle? That's the billion-dollar question. If you want to keep up with this fast-moving world, make sure you hit that subscribe button. We'll be back next time with another analysis.